Good evening, ladies and gentlemen. Warm welcome to this month's edition of Corporate Connect featuring HRnetGroup. My name is Benjamin Goh, the Head of Research at SIAS. With me is Raphael Lim, Associate Director from SGX Finlit Group as well. Also want to welcome our friends from Mubu Live. Thank you for joining us. This is an event supported or rather organized by SIAS as well as supported by SGX Group. Okay, so the sequence of events is that we're going to have Raphael talk about the market highlights, what's going on with the STI index, a little bit on the changes in the STI index and highs and lows of what's been happening in the market these days. After that, we're going to have a short presentation by HRNet Group by their Executive Director and Chief Corporate Officer, Ms. Adeline Sim, as well as Ms. Jennifer Kang, who is the Executive Director and Group CFO. After that, we're going to open up the channel for questions. We do have some pre-submitted questions. Hopefully, we'll get through that pretty quick, and then we can have go into the live questions. All right, there is a Q&A function. So we're going to be using a Q&A function from Zoom today. So if you have any questions, just shoot. And again, a little tip here is don't wait until the last minute because we tend to overrun in that particular regard. So if you've got any questions as we're going through the presentations, you can just ask. Okay, so without much further ado, I'm going to hand over the time to Raphael Lim, who's going to take us through a presentation on what's been happening in the Singapore market. Raphael, over to you.
All right, thanks, Benjamin. Let me just share my screen. All right, so good evening, everyone. Tonight I'll be sharing some of the highlights from the Singapore market in recent weeks and some of the trends we've been observing in terms of retail and institutional investor fund flows so far this year. But before we dive into the presentation, I just want to make a quick disclaimer first. The sharing this evening is for informational purposes and should not be taken as investment advice. It's not an offer or solicitation to buy, sell, nor financial advice or recommendation of any investment product. And past performance is also not indicative of future performance. So please take note of that. So I think with that, let's dive in. Looking at this slide, I think in terms of the STI performance, as most would be aware, the STI actually has been staging one of its most significant rallies in recent years. From the end of 2023 to the end of first quarter 2025, the index has been on a strong rally, breaking to new all-time highs at the end of 1Q 2025, hitting 4,005.18. This is above the 17-year, the previous high 17 years ago in October 2007. So even though the market has been making new highs, we don't see valuations in the market being very stretched at the moment. The STI currently trades at a price-to-book ratio of about 1.3 times. This is not as high as it was in 2007 when it was about 2.5 times. And also at the current levels, when we look at Bloomberg consensus estimate target price for the STI over the next 12 months, it's still at 4,265. So valuations are not very stretched. So obviously, even though it hit the all-time high in the first quarter, with the tariff uncertainty in the US, there was a sharp dip in April. But the market has been recovering strongly, and currently the index level, it closed about 39, 34 today. It's less than 2% away from its all-time highs. Now, in terms of fund flows as well, I think the chart here shows how some of the institutional activity has been amid the recent STI performance over the last 5 years. I just want to draw your attention to some of the parts in the purple boxes as well. So, institutional investors have been, there's been some net outflows from institutional investors over the years, but looking beyond the headlines, I think during some periods of comparative outperformance, we can actually see interesting trends where institutional investors are reallocating into the local markets with net buying. So in 2022, there was a period of STI comparative outperformance, and during this period, we saw some entities net buy some over 700 million Singapore stocks. Likewise, more recently in 2024, for the full year, there was some modest net outflows from institutions about 0.3 billion net outflows for the full year. But actually, if we dive deeper into the trends from the second quarter to the fourth quarter of the year, institutions were actually net buyers of Singapore stocks. They accumulated a net 830 million as the STI consensus target price also climbed from 3,600 to 41.95 over the same period as some constituents saw re-ratings. So in 2025 so far, institutional investors have been net sellers overall in the market, as you can tell from the chart. But I've been looking beyond the headline number. When we exclude the local banks, institutional investors actually have been net buyers in the rest of the market when we exclude the banks. So for the year to date, there's been about 500 million of net insti inflows when we exclude the banks. So that's something to consider. I think looking beyond some of the institutional fund flows, we also see we can also look at some of the retail fund flows in recent months. Retail investors trends, it shows less of the portfolio rebalancing activity that we can see from the institutional trends. But what this means is we can also see some indications of behavioral insights from the retail investors' fund flows. I think in recent months, we actually have seen examples of dip buying from retail investors intensifying. We do see investors rotating quickly into different stocks at times of volatility. This was especially apparent during the April market pullback, given the tariff uncertainty when the global markets pulled back. I think one example is during that time, we saw the STI banks on average fall between 13 to 14% in early April. And this really drove the retail investors to net buy strongly into local banks at the time. Over the past few years, we also have seen our retail investors net buy over 16 billion in Singapore stocks. One of the segments that have been popular for net retail inflows has been real estate investment trusts or REITs over this period. It's been a popular instrument. Net inflows is coming potentially because some investors they see the current value observed both in terms of the price to book ratios where the REITs are trading at, as well as the distribution use. Continuing on the topic of retail inflows, also want to touch on some of the recent examples that we have seen in the market. So, the trend of selling the outperformers and buying the underperformers has been observed as well in the trading activity we saw last month. So, when we look at the 25 most net sold stocks by retail investors in the month of May, I think on average, these stocks actually had a total return of 8.5%, whereas the 25 most net bought stocks from retail investors saw an average of a 2.8% decline. So again, going back to the trend of selling the outperformers, capitalizing on some of the gains that has come in, whereas looking more opportunistically at possibly value investing behavior as well. So there were 11 counters among the 25 that were most net sold by retail in May, including SIA, DBS, Keppel, and Singtel. Beyond the index stocks, there were also some non-STI stocks that saw net selling and that also performed fairly well. This includes Sheng Siong, SIA Engineering, and Franken. So on the other hand, when we look at what are retail investors net buying, I think in May we saw very strong net retail inflows in Yangzijiang Shipbuilding. It's actually declined in May, and as well as for the year to date, it's also down. So other top net buys from retail investors in May include stocks like Riverstone, Singpost, WeHer, and Netlink Trust. Moving on from the topic of fund flows, I also wanted to touch a little bit on how the banks have been performing recently. So, in early April, the tariff concerns in the US really triggered a 13.7% average decline in total return for the three STI banks. But even with this, the retail investors had a very strong response to it with 1.5 billion in net buying activity. And the banks actually have been rebounding since mid-April, averaging a 12.3% total return. So in terms of the financial performances, the banks also have reported pretty robust numbers in the first quarter. The three of them have reported 13.2 billion combined total income. Net interest income was above 8 billion for the 10th straight quarter, reaching 8.4 billion in Q1 2025. Non-interest income also rebounded. It was back to above 4 billion, reaching 4.8 billion, or up 9.9% year on year. So what we also observed from the three STI banks is they have also been very actively reducing their surplus capital, with plans for capital management over the next 3 years. This is really leveraging upon their strong financial position with healthy capital reserves. So, going to some examples, for DBS at the end of 1Q FY 2025 analyst briefing, it confirmed that there's no need to alter its capital management plan. Last year, it announced its 3 billion share buyback program, and this will be executed over the next 2 to 3 years with flexibility to adjust based on share price movements. Similarly, UOB in February this year announced a 3 billion capital distribution package to be delivered over the next 3 years. This includes a 2 billion share buyback program. And also in fact, this year, OCBC announced its plans to return 2.5 billion of capital to shareholders over 2 years through special dividends and share buybacks. So with this in mind, actually the three STI banks in 2025 are leading the share buyback consideration tally in the local market. So and actually in 2025 so far, we have actually seen a very strong start in terms of share buybacks. It's the best start we've seen since 2020, and it's the current for the first 5 months, the total combined consideration of 930 million is up about 84% from the 505 million during the same period in 2024. Now, companies often, they conduct share buybacks to support employee compensation or manage excess capital. Buybacks can enhance financial ratios like EPS or ROE while taking advantage of, perceived undervaluation in the share price. So in the first 5 months of this year, we have seen 63 primary listed companies buying back shares by way of open market acquisitions, the combined consideration of 930 million. This excludes the share buybacks from secondary listed companies and REITs. So in May, the buybacks were led by UOB, DBS, as well as Olam Group. And for the year to date, I think UOB has bought back 253 million of its shares for the past 5 months. And combined with the three STI banks, they account for about 77% of the total consideration in terms of filed buybacks for primary listed companies. So apart from the large caps, we also do see the mid to small cap companies carrying out buybacks this year. Like I mentioned, there are 63 companies that have already done so. Some other examples include companies like APAC Realty, Valuetronics, Innotech, as well as HRnetGroup, which we will be hearing more from later as well. So I just want to move on to the last slide to share more on some of the upcoming changes on the STI. So just last week, it was announced that there will be an index constituent change on the STI in June. So later this month, Keppel DC REIT will be rejoining the index while Jardine Cycle and Carriage will be exiting. Now, Keppel DC REIT will be a familiar name for investors. I mean, it was previously on the index until June 2023. So now it's rejoining the index, and with it coming back on the index, it will take the number of REITs on the index to 8. So Keppel DC REIT has a market cap of 4.9 billion. It's a pure play data center REIT, and it has data centers across 10 countries, including around 2/3 of its portfolio being in Singapore. So as we all know, there's been an AI boom, and data centers have been a popular asset class. When we can also see this in some of the valuation metrics. I think Keppel DC REIT trades at a fairly good price to book ratio. I mean, it's trading at 1.4 times, so investors clearly like such plays in the market at this point in time. So, with the 8 REITs on the index later this month, we estimate that the total index weight from the REIT segment would be about 10% when the changes take place. So these are some of the recent market highlights and upcoming changes that we have for the market in the coming weeks to look out for. But now I think that's all from me, and I think we can hear more from HRNet on some of their business and upcoming plans as well.
Thank you very much for that, Raphael. And of course, there's nothing to complain about when DBS hits a market cap of 100 billion. So that's big. Good big headline news. So that's all good. Thank you very much for the commentary regarding the changes in the index. I think it's good to have Capital DC REIT come back. We've had quite a lot of interest in that particular counter from SIAS members and audience. All right, thanks for that. So the next segment, we're going to have a quick presentation by HRnetGroup. So for some of our friends out there who are not familiar with this company, HRnetGroup Limited is one of Asia's leading recruitment and staffing firms. They are committed to building stronger companies, successful careers, and better workplace cultures. Their team of driven individuals actively engages in the market daily to provide their partners and candidates with the best insights. They are established across 18 Asian growth cities. Their business collectively provide the best services and solutions for companies, leaders, hiring managers, as well as job seekers. And if I didn't, if I recall correctly, the substantial portion of their business is actually owned by their own staff as well. So very warm welcome to Adeline, the Executive Director and Chief Corporate Officer, as well as Jennifer Kang, Executive Director and Group CFO. Warm welcome. I think this is at least the third time I've had the pleasure of speaking to both of you. And I do remember that the last time I was, pretty wowed by the fact that, your company is basically owned by yourselves. Is that still the case?
Oh, I still own shares. So does Adeline and many of my colleagues here.
Yeah. So that was, a pretty interesting story for me because most companies they don't have that. As in, once you do well, you get your shares and you sell it, and then you go and buy yourself a yacht or a good class bungalow. All right. Okay, so if you guys are ready, we can start your presentation. Then after that, we have a couple of pre-submitted questions as well as hopefully some questions are coming in live.
Benjamin.
Okay.
Right. Good evening, ladies and gentlemen. I'm Jennifer Kang, the Group CFO and Executive Director of HRnetGroup. Besides the usual responsibilities of CFO and Investors Relations, I also manage M&A projects. I'm a sponsor of 2 businesses that we acquired in China, as well as leading the startup of our Vietnam operations.
So I'm Adeline, and just now when Jennifer was reminding me that we should do intros, I thought that the best way to introduce myself really is that I'm Girl Friday. You can use whatever title you want, but I think how it works here is that whenever there's something that needs to be done, people will naturally, come at me, right? So when we first brought in our first institutional investor, I did that. Our first M&A, I did that. Creating our own hiring app, I did that. So basically, whenever there's something that needs to be solved, that's what I do. So I thought it's an easy introduction.
Okay. Thank you for giving us an opportunity to share our investment proposition and our business story with you. So to start off, we'll talk about shareholder returns. Just last month, we paid out the final dividend of 2.13 cents per share, which represented about 89% of our second half 2024 profits. Together with the interim dividend of 1.87 cents, our total dividend of 4 cents per share yields close to 6% based on yesterday's closing price, or today's closing price. Despite a decline in our profits last year, we chose to maintain the dividend per share as we remain confident in our profitability and will work towards steady and progressive returns to our shareholders. Last year, we returned $39.2 million in dividends and $3.3 million through share buybacks, totaling $42.5 million, which is equivalent to 86% of our free cash flow. Now, we still have $10.3 million remaining under the buyback mandate, which at current prices represents around 1.5% of our shares. So with a free float of 19.1%, we can continue the buybacks during periods of undervaluation. We also intend to return liquidity to the market by using our 3.3% treasury shares for M&A, employee rewards, or placements. And we are right now working on the mechanics for shareholders to choose scrip dividends going forward. Capital allocation. Prices and stressful times are happening more frequently now. From a financial standpoint, our strong cash position provides confidence to our employees, suppliers, and investors, particularly in uncertain times like this. We have $311 million in cash and short-term Singapore Treasury bills. $130 million supports our working capital in terms of our operating expenses, as well as to pay for our 17,000 contractor payroll. $10 million is set aside for share buybacks, $170 million reserved for expansion and M&A. We have one of the pre-submitted questions from an investor as to whether we are going to diversify our business using our cash pile. The recruitment business that we're in is actually a very good business. It benefits in building the social fabric of our society. It is asset-light, and it generates cash. We would expand within the HR space as it is our core competence. By capturing the HR dollar as wide as possible, we open new doors to penetrate further in existing 18 markets and opening up more business units in the recruitment and staffing space. What do we do as a business? For those of you who are joining us for the very first time, we have two key business segments, and we call them twin engines because they have the natural hedge effect on the cyclical nature of labor movements alongside economic peaks and troughs. So you see here professional recruitment, we call it PR in short form. For PR, we have our corporate clients that pay us a fee when we help them with a permanent hire, based on a percentage of the annual remuneration of our successful candidate. Our income from PR is a function of the number of placements, the fee rate, and the pay package of the candidate. Job openings typically go up and down in tandem with economic swings. Our fee rate goes by market rates ranging from 18% to 25% or even 30%, typically. Pay package is influenced by wage inflation, seniority of the talent, the scarcity of the role, and the talents in the market. And this is really a consulting practice that involves deep skills in sourcing, selecting, and influencing talents that are needed by organizations for specific business purposes. So in a year, we do about 4,000 to 5,000 placements. Next, we look at flexible staffing. This is a business where our clients pay us a recurring margin on top of the monthly payroll of our contractors, who may work on a contract ranging from years to months or weeks, or even as a temp on the daily or hourly pay rate. Companies use flexible staffing to have us take over the sourcing, hiring, and employer responsibilities so that they don't have to carry the headcount and can focus on their core business activities. Now, this business, the FS business, involves financial muscles. At least 3 months of the cash needed for salaries and social insurance needs to be on standby before our clients pay us. Only strong organizations with cash, systems, and infrastructure can run this business effectively and profitably. At any one point in time, we have about 17,000 contractors on our payroll. This is how big the FS business is. And it can become even bigger. Financial highlights. Now we'll just take a quick look at 2024's performance. Last year, revenue of $567 million. It had a slight softening by 2% against the previous year. Our gross profit was down by $17 million as we pivoted more to the FS business to hedge the sliding PR business. As such, FS contributed 52% of the total GP compared to 50% in 2023. Operating profits were down $9.3 million as we reduced operating expenses by $7.4 million. The benefits of our cost reduction efforts will continue to roll in for the future, including saving $1.6 million in future rental costs through the consolidation of physical offices into collaborative workspaces, and $1 million in the non-replacement of certain senior executives that left us. Payroll costs account for 78% of our operating expenses. And we have the advantage of pegging it to GP and profitability of each business unit in order to protect our bottom line. This feature will continue as our DNA in our profit-oriented compensation system. And this is why we can assure shareholders of continued profitability, as we have done so over the many crises faced over the last 33 years. Based on the strong foundation of our twin engines, PR and FS, we will do what we can control and continue to steer ahead. For our PR business that you see on the left, that contributes about 45% to GP. We are experiencing increases in the number of C-level and strategic hiring in the last 7 months. We see that the substantial delayering in various organizations has reached a point where criticality of strategic positions necessitated the hiring of fresh talents to steer our clients' businesses in the light of new developments happening in the world. And hopefully, this will lift our billing value to help mitigate the impact of the drag in volume. Our FS business that you see on the right-hand side contributes about 52% to GP. And that continues to enjoy recurring revenue streams. The rank and file, the preference for flexible staffing will continue. Building of key accounts for mega and government projects in Singapore, Taiwan, Hong Kong, and mainland China will give us stability in volatile times like this. Singapore is the group's largest contributor in terms of 66% revenue and 56% GP. US imposed a base tariff of 10% on us compared to much higher percentages for other Asian cities. We are not directly impacted by the US tariffs, but our customers are. Because it sounds like a goodbye to globalization, there is a good deal of regionalization. For sure, more trade flows within Asia, and we all will try to find our own equilibrium. Our Q1 and Q2 businesses have been okay. Q3 is looking uncertain, as we are still reeling from knee-jerk reactions of each political move, and that's beyond our control. But indeed, the impact is evolving.
So I'll pick up from Jennifer at this point to go into something that's...
Sorry, there's a slight technical glitch.
Okay.
There's a little map that is supposed to appear. We'll just give a couple of minutes to first tackle that. While waiting, I'll just talk through the point about our geographical diversification. Being present in 18 cities across 10 geographies, entrenched in multiple industries in both private and public sectors, give us a flexible base to move with agility. We have lived through so many economic cycles to appreciate that business and people will adapt in order to survive. Trade flows will shift, supply chains will reorganize, reroute, talent supply and demand will move. Nevertheless, our co-ownership model, which Adeline will talk about, gives us assurance of our adaptability to the changing talent landscape that comes with the rebalancing in trade flows. Adeline.
So I think Benjamin mentioned just now that something quite unique about HRNet is our co-ownership model. And in fact, right this moment, we are talking to SMU about possibly becoming a case study for them, right? Because there's no other company on the SGX with this model. And I wanted to go into it a little bit more because particularly in this current environment where crisis is BAU, where crisis is business as usual, then you really want people who are running and working in a company with skin in the game, right? So for all these people that you see here, how HRNet performs has a very direct relationship on our quality of life. So you may already know that the word entrepreneur means the person who bears the risk of winning or losing. So I can assure you that every one of them here wakes up each morning thinking about this company, how we can do better, how we can evolve and grow, and how to attract more people to join the cause. So I know we're just past our elections, but somebody said that I actually make it sound that we're a political party. And something we're obsessed. But that's actually what being co-owner run and operated means. You can feel the intensity and passion, the sense of urgency, the sense of agency, and the belief that every action we take can make a difference. So you don't find anyone going through motion, because just as it is your money and your time that you invest in us, it is our money, our time, our well-being at stake. So I can assure you that when the world is really evolving every day and so volatile, that's when we want management to be deeply invested, highly interested, and really committed to do their very best. And that is HRnet. So at this juncture, I also want to add that we have replenished the bench, and we've just welcomed the class of 2025, our new cohort of co-owners joining us this year, who bring with them fresh energy, new ideas, and the desire to do great things. And they are strengthening our bench and bringing us to a total of 46 co-owners. So just to give you some color, Deborah first joined Recruit Express, our subsidiary, as a fresh graduate, and now she's been with us for a total of almost 15 years. Daniel had a dream to be a poet, but then HRnet became his first job upon returning to China 12 years ago, and he has stayed with us ever since. Madeline was initially a MOE teacher, then a director at the Singapore Productivity Board. Agnes is a career headhunter, whilst Grace is an alumni of American Express. So I like to joke that all roads lead to HRnet. It doesn't matter what you studied in school. All that matters is that you have a deep interest in people, you're resilient and relentless about pursuing growth and improvement, and as well as that, have attention to detail. And that's about pretty much what you need to be a great consultant, a great headhunter. So consistent with the plan that we shared last year, we have been working to capture more of the HR dollar by expanding our service offerings and building out our strengths as a regional platform. And therefore, you see the birth of the manpower supply company Crew with Deborah, the employment record business Toto, the HR consulting business Leaps, and this is with Grace and Meg, as well as semiconductor focused Always HRnet, and just this year, Always First Vietnam, which Jennifer is personally sponsoring.
Yes, so much for organic growth. Now I'll talk about M&A features. Remember in 2017, the single purpose of the use of proceeds was for opportunistic and strategic acquisitions. And we will continue to explore large and bolt-on acquisitions. After 7 years of working across a range of structures, we had minority stakes, we had controlling blocks, and we had trading partnerships. We have learned to identify who is serious about building something meaningful and who is just shopping for a deal. So what we care most is actually the management team. And here you see PhD. And for us, it stands for passion, hunger, and self-discipline. And you note that the self is spelled in small letters. And the second most important factor is the runway. That was talked about in pre-elections, right? How much runway one has. For us, a runway of co-owners is simply in terms of the willingness and the ability to stay engaged for at least 7 to 10 years, to be committed in this business. And we typically assign a senior executive as a sponsor to guide new partners through integration, helping them to adopt best practices and thrive within the group. People like Adeline, myself, our CPO, quite a few of us actually adopt the role of a sponsor to help new partners get through and become part of the larger family. The search is still on as we continue to explore with business owners and co-owner wannabes in various parts of Asia and the Middle East.
So I guess the question is how we keep calm and hire on in the most unpredictable and volatile environment, because I can tell you, for one thing, we are continuing to hire for ourselves, right? And there are few reasons why, and one of them is really that the talent acquisition and staffing work we do is a gift that keeps on giving. So for companies who acquire good talent, there'll be years of value add and contributions. For candidates, joining an organization which is a right fit makes all the difference to their careers and lives, their families as well. So the economic value we create of 582.4 million is representative of just a snapshot in time, right at the moment of hiring. And in reality, the value we create is in the billions. The other thing to remember is, of course, that it really doesn't matter what kind of company you are. You can be an AI company, you can be a tech company, you can be a semiconductor company. At the end of the day, you always need manpower. You always do. So talent acquisition and staffing just never goes out of style, no matter what, right? Here you see a photo of our master recruiters. And they are a reflection of the fact that we work on curating an environment where, our people can thrive and do really well. So this was last month when we celebrated 40 master recruiters just in Singapore alone, who each generated gross profit in excess of $500,000. So we had the number one lady, she took in 2.6 million in GP just on her own. And last month, when one of our leaders retired, I'm not sure if retired is the right word when she's in her early 50s, she cashed out with 1.8 million, right? So in short, the work we do is very meaningful and it rewards well when you do a good job. Next thing is our house. So we work through collaboration, innovation, and passion. And our collaborative workspaces across Singapore, KL, Hong Kong, Shanghai, and by October, Jakarta as well, are physical manifestations of a strong belief in collaboration between our brands and across geographies, which is quite a unique feature amongst the bigger global brands, as well as the cross-selling of products to existing and new clients to capture untapped revenue streams. HRNet is a living organism, constantly evolving and innovating. And over the last few months, we have been meeting with clients across Jakarta, Bangkok, Singapore, and upcoming with KL as well, dealing with issues including managing 4 generations in the workplace when we don't even have 4 generations living together in households anymore, as well as compensation negotiations, given that budgets today are under careful scrutiny and hiring managers are cautious. What we have is a culture of high standards and high support. So no one will tell you it's easy working at HRNet, but there's a reason why people love hiring our alumni. They have experience doing great work. They know what quality looks like and what it takes to get there. So this is what will get us through this current time, when there's uncertainty and volatility. There will be, or there already is, a flight to quality, particularly in this age of AI. And that is a clear trend we are seeing. The winner-takes-all culture, where fewer people are getting hired, but those who do are getting paid more and having to do a lot more. So that's a trend that we are riding to seek out the best fit talents for our clients. And that's something really real. An equal and opposite phenomenon is the acute demand for blue-collar workers, particularly in our home market of Singapore. So people who choose to do blue-collar work, whether it's frontline F&B, retail, or logistic workers, are very much sought after. And that's a trend we're riding on. And today, whether you're at Marina Bay Sands or Sengkang Hospital, Resorts World, there are True by HRNet contractors and candidates working right there. So finally, a recap before we move to the Q&A, why your decision, to be a HRNet shareholder will be a very wise one if you're not already a shareholder. And number one, going back to what Jennifer started off with, we are delivering in the region of 6% in dividend yield. And while investing in us is not risk-free, we are debt-free and financially robust. So with nearly half of our market cap backed by cash, with dry powder ready for M&A and other opportunities when they arise. When it comes to HR, we are the only co-owner-led regional platform in the world with boots on the ground in 18 cities across Asia, built to last for 33 years and counting. So, there's really no question about it. It's a great choice, and I go back to the fact that HR is a necessity. The word company originates from com and pani, people coming together to break bread. So there will be no company which doesn't require manpower as sure the sun will rise. And no matter what crisis strikes tomorrow, no matter what fight Trump and Elon decide to have, we will live to hire another day, and we'll be providing staffing services, workforce management technology, and we will see you next year and for many years to come. So, yeah.
Well, thank you very much, Adeline, as well as Jennifer. I really love the story of one of your colleagues retiring at early 50s, cashing out $1.8 million. If she's looking for a good fund manager to manage her retirement funds, I can put up my hand. Okay, just kidding. All right, ladies and gentlemen, we do have a couple of pre-submitted questions, and 2 questions have come in through the Q&A function. I think 3 of them are kind of related. About AI, Gen AI, ChatGPT, so on and so forth. Maybe I could just paraphrase and summarize for Adeline and Jennifer to answer. So given the rise of artificial intelligence, the prevalent use of Gen AI, how do you think that kind of technology affects your business in terms of your business model, the efficiency that you can gain, and very specifically, you are in a high touch business, right? So relationships matter. But in this age of AI and with younger generation of, practitioners coming in, wouldn't it be easier for them to just, kind of talk to AI rather than somebody from your firm? Is that going to be a threat for your business? How do you intend to counter, and, do you use Gen AI yourself?
Yes. So, if I can take that question, basically, we don't see it as a threat, we see it as an opportunity.
Mm-hmm.
So our number of trophy assignments, so our higher value assignments has actually gone up dramatically this year. Because, we see as a large factor is the usage of Gen AI, right? So there's the expectation that every person that you hire actually has to have far greater output. There's more expected of everyone who's on the job. You might be paid more, but you definitely have to do a lot more. So same thing happens for us internally, right? So we are very avid users of technology, and we started putting in place AI rostering. So with all our contractors, we have put in place AI rostering. We have an AI chatbot because the contractors have questions like, where can I get my payslip, or how many days leave I have left. So in a way, we're cutting down the amount of grunt work that our people have to do, and putting in AI whenever we can. And even the first cut of our reports to our clients, our candidate reports now, actually is generated by AI. Having said that, I think many times you actually do need the human to come in for that discretionary decision to be made. And all the more so when it comes to hiring. Because if you think about it, I think next to your spouse, your boss or your team member is the next other person who influences the life the most and who you spend the most time with. And the reality is that AI is only as good as the data that gets fed into it. And with data protection laws and privacy laws, there's actually not much data that appears in a CV or in a job description. A lot of critical factors or scorecard factors in the end come up when our consultants speak to the hiring managers as well as to the candidates. And that is when there's much more that's unearthed, and the whole idea of chemistry within a team, what works, what someone's looking for, then comes out. The amount of data that is present in a CV actually has been drastically reduced over time. And so you can feed it into an AI agent, but nothing much will come out of it. So what we actually have to do and what we have been doing actually is to help make our consultants more efficient and effective, taking away the grunt work that they need to do, but then, letting them focus on where they really add value, which is that human dimension, which, still makes a difference. Unfortunately, I would love to say that we don't need to have recruiters, right? Then that will cut our costs by tremendous amount, but not just yet.
I think it'll be pretty unsettling if one of your clients wants to hire, for a CEO and then uses ChatGPT to scan through the CVs. That's like, oh my God. Probably Elon Musk does that, but no sane adult will actually do that. So it does sound like AI is kind of like dividing the marketplace. So for the very entry level kind of stuff, AI can handle it pretty efficiently. But for the the kind of roles which require experience, people skills, so on and so forth, then HRnetGroup still is very much in a business of using its relationships as well as its human beings to get the deal done for his clients.
I can share with you a threat to Singapore.
Mm-hmm.
With ChatGPT, we found that the quality of the written reports that were created in Thailand, in Vietnam, in Indonesia, and even Korea, suddenly the gap between Singapore and these cities just closed up.
Mm.
But it used to be you can look at a report and you can tell this is not the person's first language. And there'll be some grammar errors, or maybe the vocabulary is not the same.
Mm.
But now, and I feel it really strongly in Indonesia, because the cost differential is very great between Jakarta and Singapore. And the quality of work really is not that different, especially if you are a fresh grad. It's a big problem for Singapore, I think.
Okay. But I suppose for specific roles where it's direct client engagement, or where you need to manage a team, people's skills will still come into play, and it's quite important. Okay, cool. Thanks for that. Okay, let's see. The next question is talking about diversification plans. So you've got a pool of cash, cash equivalent assets. Is the strategy of a company to remain asset light? And associated with that is you do have a portion of cash set aside for potential M&A. So anything to add to that? To add color behind any kind of potential M&A, and of course, don't get yourself in trouble. Don't tell us any kind of insider information until we end the call, then you can tell me Just kidding. All right. So, what are your thoughts?
Yes, I'll take that question. On the subject of M&A, we must first go back to the intent of M&A. So the intent is basically expansion. And if we talk about expansion for our line of business, there are two primary channels. The first channel being organic. Organic is always the safest bet. Slow, steady, but very, very solid in fundamentals. We cultivate people from young, and they grow over time, and it takes years before you get a really fine crop of people that can represent the brand well. And that's always our favorite. For the first 25 years of our organization building, we lived and breathed only organic. And there was a person, Wu Yilun, that asked the question and commented about the use of cash for potential M&A. You are absolutely right that there has been no huge M&A activities since 2021. But I'll give you some color that generally so far we did about 5 M&As, and I would classify them as small or medium-sized deals, because generally the smaller size deals tend to have lower risk, easier integration, and we have good in terms of support for moving people together. Generally, we like to have at least 51%. So having the founders or the team of founders holding 49% is a very good form of assurance to us that they continue to have skin in the game. So generally, we don't buy 100% unless it's for very, very unique situations where we can take over the contracts 100% on day 2. But along the way, we also discovered there is a new channel other than organic and inorganic, and that is what we call hybrids. Hybrids are JVs that we set up with co-owners of businesses that we acquire through M&A. So they get adjusted and assimilated into our culture, our work processes, our systems, and our way of talking, our way of life, that they want to do more with us. So in the early days when we did our acquisition, we had acquisitions for professional recruitment businesses, headhunters, executive search. But as they come into the group and they witness the tremendous growth potential of flexible staffing, we actually had a group of people, or 2 groups of people, one in Indonesia and another group in China, that put up their hands and say, can we form JVs to set up flexible staffing businesses? And that's how we grew new outfits like Recruit First Indonesia, Recruit Fast in Shanghai. So that gives us the 3 avenues. We continue to aspire to have large acquisitions, but we all bear in mind that it's higher risk. In fact, between Edwin and I, we have run many places on huge acquisitions in Australia, in Brazil, in London. And we must say that by and large, we are rather prudent people. And while we are very attracted by the ability of flexible staffing to have that scale, we are quite cautious in managing the cash power that we have. And to the question as to whether we'll be covering more jurisdictions or consolidating in current jurisdictions, I think the game plan is still deepening our presence in existing markets, as well as keeping an open eye for new markets. So as Adeline was talking about in Vietnam, I am personally working on the startup in Ho Chi Minh City. I am also talking to people in the Middle East, hoping to open up an office in Dubai in the near future. So 18 cities, 10 geographies, there is a lot that we can do as it is, and we will continue to do more.
Wow, there's a lot of geographies. I mean, how do you guys get any sleep, like on a plane or something?
Live out of the luggage. Don't unpack.
Goodness, I would never be able to do that. I'm not
this morning we were having a discussion because we're tightening on our own cybersecurity. So we're locking down the cities. I mean, basically, we have to let the tech team know when we travel in each city. So they were just laughing that for the both of us, it's quite ridiculous to keep reporting where we are.
Yeah, IT is going to go mad.
Okay. Thanks for that, Jennifer. So thanks for the color behind the M&A. Is that so? How does that coincide with the diversification plan? So you spoke a little bit about JV, but I guess in that regard, the traditional definition of diversification does not really apply to HRnetGroup, because you have the core business, which is talent acquisition and staffing, so on and so forth. So that's unlikely to change, right?
We've added more. So in terms. So diversification in the sense that we've just added Vietnam as a geography. That's by geography, but even by product mix. Up till not so long, up to 2021 or so, we didn't have a workforce management app. platform. We didn't have HR consulting. We didn't have the EOR business. So we've been adding on to the suite of services that we offer to the same clients. And saying beyond, we used to engage with them more at the start of the employment relationship for the talent acquisition bit, and then we're staffing for longer. Now we say we want to stay with you throughout the employment life cycle. So that, basically there are many more times for work to be done.
Cool. I really like the fact that you guys are leveraging apps and technology, so that, in the middle of the night, one of your staff can just text you, I want to quit, get me out of here. Just kidding. Actually, I've done that before, but anyway. Okay, next. Right. Let's get on to the economics. So a lot of news about Trump on and off, tariffs, his bromance with Elon Musk, up and down. So how is that affecting your business across all the different geographies? Any changes in the hiring landscape, risk factors, regulatory changes? I don't know. It seems like a different world before the beginning of this year.
Yes, totally right. So I think Jennifer alluded to it that, for example, Q3 right now, it's still an open book, right? How it's going to turn out. We kind of fought through Q1 and Q2 pretty well, we felt. But the uncertainty goes on. And it is really not uncommon now for a client to say, hey, let's just pause on a role that we've been working with them on, because they don't know what's going to happen next, right? Yeah, so the uncertainty is quite crippling actually for some clients. It's across the board. It's not just in Singapore. Yeah, so even Indonesia, don't say China that, right? Everybody's just, the CapEx spending is definitely a lot lower than what it should be.
Okay. So touching on China, since you kind of piqued my interest there. I mean, the job market is a little bit kind of a mixed bag, right? So you've got higher elevated unemployment for like fresh grads, people with little experience. But it does look as though the property crisis is kind of recovering already. So given another 2 or 3 quarters, they might actually come back. And I saw in your montage, you've got quite a few co-business owners from China. So how is that affecting your Chinese business, and able to add any color for that?
Yes, property, very interesting. Very interestingly, property is actually one of our team's specialization in southern China. And surprisingly, those players who are very robust, very strong financially, they continue to hire. And in fact, we just closed a few big cases in the property sector. Semicon, that's another interesting one. Semicon is facing quite a lot of churn at the moment. I mean, 6 months ago, people were talking about the foundries hiring, and then suddenly it stopped. And then we are seeing a lot of start and stop within the semicon. But as always, people need to live, people need to make a living. There will always be turnaround situations. So last week, I just got a call from one of our business leaders to say, one of the government departments is doing a ban on all headhunters who poach their people, and they ban companies from taking on their employees, whether it's by headhunter or by natural migration. And so we had a lot of assignments that were suspended. And then we had panic calls coming to me, and I said, stay calm, because things will happen in the next 1 week. And true enough, it's another restart. Because with those people that are out of the radar, the client turns around and say, but we still need people for the job. So can you give us the backup guys? So business continues. It's always happening. There will always be immediate reactions, but then our people just have to be very steady and just move on.
Okay. Sounds like China, as always, is a very interesting place to do business. Okay, we do have a question that came in through the Q&A. So I think this is a long-time follower or perhaps a shareholder. So since speaking in fiscal year 2022, number of placements as well as number of contractors have been on the declining trend. until fiscal year 2024. So will you be able to add some color behind that trend?
So I think the economic environment is definitely one factor, right? So when there's more uncertainty, people rather move towards staffing. It just feels like you have more agility to dial up or dial down your workforce according to what you need. So when the horizon, many people now say you can't forecast it with the whole of next year. If you can forecast a quarter, you're very good already. Right? So in such a case, you rather use staffing. So that's one reason. But the other reason, which was alluded to earlier, really is the rise of AI. So I think in such a case, really, the number of permanent placements has come down. We find that in many cases, the client is saying, I'd rather hire somebody who, with the usage of AI, can perform the role of 2 people or 3 people or more. Yeah, than to hire many headcounts, which collectively could cost the same, but I'd rather just work with one guy. So it's, I guess, it goes back to the days when WhatsApp was acquired, they had 19 staff, right? So it's almost like we're going back to that, right? You'd rather have just one super engineer than a whole army. It's like, yeah.
So does that mean that although the number of placements and is going down, but I guess the dollar value of the deals are kind of going up because you got more high quality placements and mandates from the clients? Is that the case?
Might be. If we're talking about the balancing between volume and the fees, and the fees is again a function of the kind of package that the candidate gets. So if we are hiring very strategic positions or C-level positions more, then that could sort of compensate the reduction in the volume.
Okay, that makes sense. All right. Let me see. Okay, time now is 2 minutes past 8. I think I'll just pick one more question here. So how does HRnetGroup, what is the strategy to ensure consistency and quality across all its, geographies while remaining agile to local market needs?
So in one word, the answer is technology.
Okay.
It's true, right? In fact, this is very much our sweet spot. I mean, we're talking about Goldilocks porridge, right? So HRNet really is the only regional player, boots on the ground in 18 cities, and structured, our incentive structures and are structured so that our people want to work together across geographies. So for some of our global peers, they tend to be within each city, right? They don't work as much across geographies. But for us, we are structured as such to work together. And then how can we do so? It really means that whether a piece of work is done in Jakarta or in Ho Chi Minh, or in Seoul, or in Shanghai, the client cannot know the difference. They must not know the difference, because otherwise they'll be like, hey, you have differing standards. So on quite a number of levers, so including our delivery time. So we say, even though local clients might accept a longer delivery time frame in let's say in Bangkok, but we're like, hey, let's stick to the same, within 3 days, send out 3 profiles kind of timeline. And the format of our reports and the content and the structure is consistent throughout. So it's in our CRM, whether the report is produced in Singapore or in KL, it looks and feels exactly the same. Similarly, even our own performance management is also managed on our systems, right? So it doesn't matter where you are. Every Friday, you're going to see all your numbers and activities as well. So how many calls you made, how many people you met for interviews, how many interviews you set up with our clients. The matrices are the same. And that is what allows us to give that consistent experience. So we like to joke. It's something like, no matter where you go, the Four Seasons or the McDonald's feels exactly the same, right? Yeah. So we want to create that same experience as well.
Yeah, I mean, that's great. So, the same client engagement quality, the same out-of-box experience, that's fantastic. Okay, so at 5 minutes past 8, we don't have any more questions coming in. If you guys have got, we can take one more question if you want. If not, we will call it an evening. So maybe just give it one more minute. Yeah, so as we're waiting, the McDonald's experience is like going down a drain. The Big Mac, I don't know why they call it big anymore. It's like, yeah. So
Big
yeah,
enough for you?
yeah, it's it used to be like you can't shove this in your mouth, and now it's like, oh my goodness, someone sat on this, right? So okay. Okay, I think that's it for this evening. We don't have any more questions. So I want to thank Jennifer as well as Adeline. Always a pleasure speaking to you. And I love the chit chat. I love the candor. I love the business model that you have, your cool business, ownership, so on and so forth. Unfortunately, I've got a very short attention span. That's why I'm in banking and finance. I just live from one market day to another market day. But if my employer had that kind of business model, I would have, that would have been great for me. So thank you very much. And for all our friends out there from SIAS as well as Mubu Live, thank you for spending your evening with us. Thank you, Raphael. SGX, highlights on the market. Right.
Thank you very much. Very nice to speak to you all.
Thank you so much. So have a great evening ahead.
Thank you.
Bye-bye.
Bye.
Bye.